Hello, good evening. Welcome to a very interesting edition of our Why Business podcast. My name is Emmanuel Bikmire. I'm a lecturer, researcher focusing on international business, but I'm also the CEO of Why Investment, and one of our core objectives is to provide investment education to the general public, but especially to African diaspora community in Europe and across the world. This special day, I'm very delighted to be joined by Mr. John Brenninkmeijer, a very well-regarded value investor based in the Netherlands. Mr. John, can we get to meet you? Tell us about who is John.
Thank you. I'm John Brenninkmeijer. I live in Amsterdam with my wife on the canal here, and I've studied business administration, and then I was working in retailing and stores, and in 2012 I read The Intelligent Investor, and then I found some gentleman who had written a book about Warren Buffett in Enschede, and we set up a fund in 2018.
2018, interesting. So what struck you about this book on Warren Buffett, and what is it about Warren Buffett that caught your interest?
Well, Warren Buffett is a lot like you, because he said, when I pass away and they have my gravestone, I want to have standing on it, Warren Buffett teacher. And he was always trying to teach people and explain his insights and so on. So that's something I really like.
That's interesting. So what is unique about Warren Buffett value investing strategy that you more or less adopted?
So when the financial crisis came in 2008 and 2009, I saw the prices of all these stocks going down, and I sort of assumed that the value of the companies was also going down in the same way. And Warren Buffett's teacher, Benjamin Graham, said you can make a distinguish between the market price and the insanity of the crowds on one hand, and the value that you can calculate on the other. So price is what you pay, value is what you get. And that's something we still don't see that much of in the Netherlands.
Okay. So let's dig in a bit further. So you are saying that the price of a current stock may not really reflect the value. How do you know that?
Well, if you look at a business and you say, okay, how much property does the business have? What is the book value? What is the cash flow? You can make a sort of private equity valuation. And then if you take the private equity valuation you've made, or a bit of a guesstimate, you divide by the number of shares outstanding, then you get a guesstimate of intrinsic value per share. And only then you should switch on your computer and see what the stock price is.
Okay. If I may go further, then what do you do with this? Let's say you've done the calculation, you see the intrinsic value of a stock, and then you open your computer, you see the stock price.
Yes.
What happens next? What do you do next?
Usually you're disappointed because the price is too high.
Okay.
But if the price is lower than you expect, then you can research why could the price be lower? Is there something unexpected happening in the day or so on? Or what is the sentiment maybe against it? And if you have an idea why the crowd could be wrong, then you could buy the stock based on the opportunity cost you might have if you buy that stock instead of buying another stock.
Okay. So, but why do the market sometimes misprice a stock? What do you think?
It can be a number of factors, and one of them is what they call momentum investing. So people are buying as the stock price is going up, and that keeps it going up. And then as the stock price is going down, sometimes people are investing with money that they've loaned. So that's called buying on margin. And if the price goes down very far, then they get a so-called margin call, or nowadays a margin email saying you have to put in extra money or the shares will be sold. And that triggers it going down as well.
Okay. Okay, interesting.
Yep.
But there's something that I really wanted to ask you.
Mm-hmm.
Yes, there could be a discount based on what you just described on the value of the price of the stock.
Mm-hmm.
But how do you differentiate stock whose value is actually going down
Mm-hmm.
and the price is going down? Because the one that the value is still okay, but the price is going down. How do you sort this? How do you sort of, I don't know if the question is clear.
Yeah, I think so. So there are companies which lose money over time. One that I was looking at today is Air France KLM, so an airline company, and its book value per share, its cash flow per share, profit has been slowly going down over time. And there, if the price of KLM goes down 50% today, we still might not buy it because we would say the stock price might never go up because the value might keep going down.
Okay. Yeah. Okay. So you just touched on something there. You look at the book value.
Mm-hmm.
So in assessing a company to determine if it has great value, what are some of those key criteria that you use? I don't know if it's a secret, but if you would like to share a few of those very important criteria you use.
Yeah, well, you have on the balance sheet, you have two things. On the one hand, you have the assets. So what does the company own? And the other side, the liabilities. What is the debt to the company? And Charlie Munger, he says, when you're looking at the two things, the assets and the liabilities, you know for sure that the liabilities are there.
Okay.
But you're not sure about the assets.
Exactly.
Yeah. And so you look at how much tangible book value there is, how much goodwill there is, and you prefer tangible book value over goodwill.
Okay.
And but what's also just important over time is the trends. So when I was starting, I thought, I should buy Ford Motor Company shares because they have a very low price earnings multiple. And Peter Lynch, he explained that over time, if a company's earnings don't go up, then the price won't go up either. The price earnings will stay maybe at 7 for decades. And if you have another company that's growing and flourishing, then the price does follow the earnings up.
The earnings after some time. Okay, interesting. Thank you. And you talked about meeting friends that wrote the book about Warren Buffett. What have you done with this knowledge in terms of investing? Can you share?
Yeah. So this is the book. It's in Dutch, called Learn How to Invest Like Warren Buffett. And my friends wrote it around 2000. And they went to Omaha, Nebraska, and met Warren Buffett. And we should have a signature here somewhere.
Okay. Oh, really?
Yeah, I'll check. Yeah, I found it. And there's the Warren Buffett signature. Okay. And let me see, now I forgot your question.
Yeah, the question was, so you now
Mm-hmm.
have this knowledge about value investing.
Yes.
What did you do?
Yeah.
What
Yeah.
step did you take
Yeah.
to transform that into a business?
Well, so first for myself, I was lucky that I was born in a wealthy family. So Warren Buffett calls that being in the lucky sperm club.
Okay.
And our wealth was growing at around 5% a year or 6%. And then if that continues, say for 60 years, then you'll have €1 becomes 30, but you also have to subtract 2% inflation and 2% tax maybe. So it's not growing at all really. And then Buffett said 12% a year is a good return or a reasonable return. And if €1 is invested at 12% for 60 years, then after 60 years you have €900. So looking over long term and also for next generations, say you have a choice between 33 and 900, then you should go for 900. Yeah. And then I asked my Hendrik Oudenijers and Bjorn Kuil, you guys give out information, you've written a book, would you also maybe like to set up an investment fund? And they said yes, so we set up the fund in 2018.
And how is it doing? Tell us about the performance of the fund.
It's going okay. And since 2018, it's increased from one investor, Hendrik, my colleague, to over 300 people and companies investing with us. And their return has been around 13% a year, so above the 12 that we were looking at. So that's nice. And then what we really like is that a lot of the investors with us are either farmers or entrepreneurs, business people, so they understand what they're investing in and that it's really businesses and it's not just moving lines on a screen.
Okay, interesting. 13% is outstanding performance. And if someone is interested in becoming and participating in this fund, what is the criteria?
Well, the criteria is that we can do due diligence on how they earn the money. And we have to do that for the Dutch Security and Exchange Commission. Here it's called the Authority of Financial Markets.
Okay.
And they have to invest at least 100,000. And we also talk with them that they really don't need the money in the next few years. We say, keep in mind about 7 years. Because it's possible if you invest 100,000, say on the 1st of June, the price might fall by 30 or 40% by the 1st of July. And if you need the money then you have a problem.
Okay, interesting. It's clear. Let's go back to the strategy bits as well. It's clear you buy value equity at a discount, but you just touched on the fact that sometimes the price might go down temporarily for a few months, up to 30%. What gives you that conviction to stay the course in such difficult moment? Because it will be tough, especially when you are handling people's investment.
So because we distinguish between what we own, and what we own is, say, shares in Google. So we own shares in the search machine, we own shares in the AI services, we own shares in Gmail. And we own Amazon, so distribution centers. And for example, with Amazon, not recently in 2022, the price of an Amazon share went down 50%. So if you're just looking at the mark to market or the quoted value, you think, oh, I've lost 50% of my wealth. But if you look a layer further, then you see that they had 1,000 distribution centers. And at the end of the year, you had 1,100 distribution centers.
Okay.
So your wealth is increasing, but the price that people pay for it is changing.
Oh, interesting. Very good. Okay. So you keep tab on the company that you invest in. Okay. Wow. Okay, that's interesting. And then the other thing was, I wanted to check with you was, it's very clear what you said about how you select the stocks that you own. But how do you manage risk in a portfolio? Because I don't know if you will get 100% perfect selection.
I know for sure we won't.
How do you manage that?
So when we started, we said, how do we want to manage this? And we said, okay, we don't want to do more than 15% in one stock.
Okay.
And then our compliance advisor at the time said, no, you have to change that, because if you do 15% in one stock, you could have 15% in Berkshire Hathaway A shares and 15% in Berkshire Hathaway B shares.
Okay.
And then you would have 30% in one company. So we say not more than 15% in one company.
Okay.
And to a certain extent, we look at 7 years out, and how sure are we that the company will still exist? How sure are we that we'll still be the owners? So we've limited risk, for example, with our investments in China to not more than 20% of the fund. because otherwise at a certain point in 2022 we would have had, just following sort of algorithms, more than half our money in China,
okay.
in a communist country. That's capitalist shareholders.
Yeah.
And so there we see a bit of a country risk. Yeah.
Okay.
But we risk for us is not volatility. Our risk is the probability that the business might go bankrupt, or you as a shareholder will have your shares taken away, and things like that. Yeah.
So is that the only way you manage risk? So portfolio diversification, which is, like you said, not more than 15% in a company. Are there other things that you use to manage risk?
Yeah, well, we only invest in companies that are making money at the moment. So that's a big thing. So we're not planning on turnarounds. We're not in startups saying we hope they will make money, but they're as we're sitting here, my investments are making roughly 1 cent per second. So it goes tick, 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 tick. The ones that I have in ValueMachine Fund. And we also look at the balance sheet, and then we say, will the company be able to pay the interest on the loans it has, even if the profits and cash flow go down, and that's called the interest cover. And if it's too leveraged and the company hits a rough patch, then usually the shareholders are the last ones to get money, and the people who have loans are the first. Yeah.
Okay. You talked about, I just want to take us back to a question related to exposure to China. You've talked about criteria for selecting value stock, but how much weight do you put into the macroeconomic context of where a company is operating, or macroeconomic context in general? Because like we see now, geopolitical tensions, dynamic context, things are changing really fast. How does that affect what you do?
Hardly at all. So Warren Buffett and Charlie Munger, they say, when you're swimming in the ocean, you have the tides going in and out, and tides are predictable, but macroeconomics are maybe a bit less predictable. But you focus on the swimming and you look at the individual companies and how they're doing. And we spend zero time predicting interest rates or what the Fed is going to do.
Interesting. Okay, and you keep referring to Warren Buffett, Charlie Munger. I'm sure, you anchor your trading philosophy and principle from them. But what are the maybe top 3 lessons from Warren Buffett that you would like to share with the public that really inform the way you look at stock value investing?
Well, it's not only value investing, but just how you live life and stuff. And one is not to take yourself too seriously. So if you look at Warren Buffett and Charlie Munger, when they're together, they're just having fun, and they can't get everything perfect. So you have to accept that. Another one, a lesson here, is a bookmark that we have. And Warren Buffett says, generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents and knowledge, nobody can take it away from you or tax it.
Interesting.
And I like that lesson.
Yeah, indeed.
And then the third is called Socks and Stocks, and you know that one. And Buffett says whether we're talking about buying socks to wear on your feet or stocks, shares in the stock market, I like to buy both when it's quality merchandise and the price is marked down.
Interesting. I know that is the motto for our WhatsApp group. What is this here? Do you mind explaining? And how does it relate to what we are talking about?
So I was reading a book called Priceless, and here's a penny falling, and this is what we call our money-making machine. So it has little wheels and a spring, and a thing on the back, and it spits out euro cents. So about 10 cents an hour, 1,000 euros a year. And it's a metaphor for owning companies, whereby we say, if you have a money-making machine that creates 1,000 euros a year, and this year and next year and the year after that, you can give it to your children and your grandchildren, and it lasts 1,000 years. So 1,000 times 1,000 euros.
Yeah, it's quite interesting.
A million euros comes out. And then we say, what would you pay for a machine that will produce 1 million euros over 1,000 years?
Yes. Okay.
And what would you pay for that?
Wow. I need to think about that a bit, but
a cash flow of 1,000 a year.
Cash flow 1,000 a year.
And you want to make 10% return.
See.
Then we say, we're getting 1,000, we pay 10,000, so we're getting 1/10, and then we have a 10% return.
Yeah.
And in the stock market, you could also see that just very roughly as a price-earnings ratio of 10.
Of 10. Okay, interesting.
Yeah.
So to get 1,000 a year, maybe you invest 10,000 more or less in a value company that will spit out 1,000 every year.
Exactly. And then and the stock market, sometimes people are very enthusiastic and sometimes they're depressed. So after 1929, there was a stock market crash, and then you could buy 1,000 of earnings for $4,000.
Okay.
And then just the index. And then in 1999, the stock markets were going up in the dot-com bubble. And then in general, for the index, to pay the same thing was the price not 4,000, but 44,000.
Okay.
With the high price earnings ratios.
Okay.
I'll put it out now for the noise.
Okay, thank you. I mean, it's a very good way to explain value investing.
And this clock is one of the only two in the world.
Oh, where does it come from then?
It comes from a physics teacher who makes clocks in the north of Holland.
Okay. Wow.
It's called Willy Kampica.
Okay.
And the other one is in the closet.
Okay, you got it too. Nice. I mean, I'm just thinking, do you have any geographical focus in terms of where you select your portfolio of stocks? Is it North America or across the world?
No, we don't have a geographical focus. We like Americans in general, because they're businessmen and women, and they're innovative and they like to take risk. And for example, in artificial intelligence, the Americans are just building new energy centers next to the data centers. And in Europe at the moment that's not possible because of all the regulations and getting a permit. And I was looking at a company in Africa, in South Africa, and I thought it was very good and I was enthusiastic. And then I switched on the computer and I tried to buy the stock, and it turned out you had to open a brokerage account in that country before you can buy the stock. So that limits us to.
Okay, interesting. Another thing that I wanted to check also was the world is changing. You just mentioned AI and the implications that it has. In your view, as we sit now, how would it change the concept of value investing, if at all? Because we have agentic agents doing things, we have so many algorithms, how do you call it, algo trading, and all of those ones. How does it?
I think in general it's going to change a lot. On the other hand, you have a saying, the four most expensive words in investing. Do you know them?
Four most expensive word? The one that I know is be greedy when they are when they are
Be
panicky.
greedy when others are fearful. Be
And be
fearful when
they
others are greedy.
That's the one.
And then the other one is this time is different.
Meanwhile, it's not, right?
Right, when it's not.
Yeah. Okay.
And so we think in the end you pay €1 to get €2 back in the future or €4 back. So investing is waiting to get paid.
Okay.
And you're buying earnings. And so we thought, to tell the truth, that Bitcoin, for example, would never go as high as it is, and we thought it would crash much faster. But we still today would not buy Bitcoin because that's more speculation. You don't have a money-making machine creating cash flow. On the other hand, I really think that artificial intelligence will have much more influence on society than most people think. I don't think it's just a tool. I think it's really a new life form, basically.
Okay. Yeah. Just one of those questions that's always been on my mind is around exit strategy. Value investors are known to be great pickers of stocks. But when do they sell? Is there a clear rule also for when you consider it's time to sell this stock?
Well, if you ask somebody who's doing value investing or growth investing, it's basically the same, or intelligent investing. Many, their biggest regret is that they sold a company too soon. And we had that, for example, with Netflix. My colleague said it was at a low price, and then within a few months the price doubled. And then they sold, and now the price is 20 times as high. So that costs more in terms of opportunity cost than buying something for one and then having the price go to zero. But you don't see it. You don't see it. But if you look further, then you see the opportunity cost. So what we would do is slowly bring down the amount of money we have invested in the company. Now we're doing that, for example, in Google. We had 12% of our fund in Google. The price has gone up, I think, more than 100% in the past year. One of the biggest companies on earth, and not that many things have changed. So then we brought down our exposure to 5%. And if Google would double in price in the next month, then we would probably bring it down to zero. But we have a guesstimate of what we think the intrinsic value would be.
Interesting.